We saw energy helping to lift the 500 today, Larry. No big surprise when you look at the moves we saw for oil.
Yeah, oil's been a lot of key developments in the last few weeks, all of them on the supply side, all of them very damaging to my short-term portfolio, but spare capacity is getting tighter and tighter. Iran's becoming more of an issue to the market than what was feared. Log jams in Canada, the lower 48 here in the United States, also with Libya, port closures. So everything seems to be on the upside. And boy, it's been tough. I still maintain that we'll see a lower oil price by the end of the year. In January, I thought we'd see in the low 60s, and boy, that seems pretty foolish at this point, but I'm still maintaining that view, given some macro factors of a slowing economy, the fact that spare capacity can come back online, and oil's well over $100 a barrel in a lot of the emerging markets. So I'll stick to my call.
All right. Well, I like conviction, and differing opinions is what makes a market. But Larry, you referenced some slowing in the global economy. However, if you look behind some of the trade headlines, the cyclical story is still talking about, firming global economy led by services, manufacturing perhaps not necessarily so. But I mean, the global market does still look strong.
Yeah, I agree. I mean, I think it's a little bit crunchy, with emerging markets. I mean, good grief, that could be the best buy of the decade if things get figured out. But you're right, services have outperformed. Manufacturing is a little bit behind, but I don't think manufacturing is going to continue to decelerate. I mean, I think overall, global GDP is doing, quite fine. I mean, there's pockets where we have seen deceleration, but no need. I mean, I'm sorry, in no way is it universal. And most of these data points are, coming off a very high level.
So if you look around the globe, take a real macro view, where do you see opportunity? I mean, we've got the U.S. market continuing to keep on despite trade war fears, despite a Fed that's clearly on a hiking timetable. So where do you look? Do you look to the emerging markets? Do you look to China? Do you look to Europe?
Well, I still maintain my overweight in Japan. That's worked out quite nicely. Overweight in Europe, that has not worked out terribly nicely, but it's on its way. The cyclicals, especially in the Eurozone. U.S., I continue to be neutral, not because I'm negative against the United States, but I just think it's closer to end of cycle than beginning of cycle. And when it comes to emerging markets, I am definitely neutral, just waiting a little bit, and I'd rather see somebody else take that risk right now.
Okay, so when we get to what we're looking forward to, obviously earnings, but on the economic front, we do get CPI, PPI released this week. What are we expecting there, and how do you think that's going to form the view for the FOMC and expectations of the hike, that extra, I shouldn't say extra, but the fourth hike coming in December?
Yeah, no, great point. I think unless CPI comes out grossly different than expected, I think the market has baked in the fact that the Fed will hike one more time. It's pretty evident by the curve that we're looking at right now. But people have to realize that really has no bearing on long rates, like to 10-year and a 30-year. It's really the short-term rates, and I think that the market has baked that in. I almost think that if the Fed did not raise, that would actually be a headwind to the market, where we're losing confidence in what the Fed has implied it would do. So with that in mind, it's going to be very interesting to see the yield curve. One important fact is that you see 3-month paper versus the 10-year yield. It's below 100 basis points, the first time since 2008, and some people are signaling recession. I don't see that right now, but it's something worth watching.
Yeah. All right. Larry Schover, we've got to wrap it there. We're out of time. Thank you. We'll speak soon.
Thank you.